Should we start, Sakko?
We can start. It's
Yes.
2 p.m. We can start our webinar.
Okay. So please let me know whether I am audible or not because internet connection is not stable here. So
You're audible.
okay, thank you.
You are audible. You are audible.
So okay. Hello everybody and good to have you all. Though I am from the Department of English, but I take pride in hosting this webinar in as much as most of the members of this Department of Commerce will be turning up later on. So today we are live again, and once again a very hearty welcome to all of you and to this uh, one day international webinar organized by the Department of Commerce, Navagram Hiralpal College on contributing components to banking crisis and macroeconomic impact of COVID-19. We feel very honored to have with us two of very renowned scholars and thinkers with new topics. Dr. Kuntal Das, Senior Lecturer in Finance, University of Canterbury Business School, New Zealand, and the Director of New Zealand South Asia Center, will be speaking on bonanzas, booms, and banking crisis. And Dr. Rajiv Bhattacharya, Associate Professor, Department of Economics, Goenka College of Commerce and Business Administration, Kolkata, will be speaking on macroeconomic impact of corona pandemic with special focus on the Indian economy. So to begin with officially, I would like to hand over the microphone to our admired President of the governing body, Navagram Hiralpal College, Sri Apurva Majumdar, to inaugurate the session. Sir. Are you there, sir?
Apurva Babu, please unmute your mic. Yes, sir. Now you can speak, sir.
Hello.
Yes, sir. You are audible, sir.
Yes, sir. Yes, sir. You are
Okay.
audible. Please
Okay,
go on.
thank you. Okay, thank you. Good afternoon, everybody. Today, one day international webinar on contributing components banking crisis and macroeconomic impact of COVID-19, organized by Department of Commerce, Navagram Hiralpal College. I cordially invite Dr. Kunal Das, Senior Lecturer of Finance, University of Canterbury Business School of New Zealand, Director, New Zealand South Asia Center. Also, I invite Dr. Rajiv Bhattacharya, Associate Professor, Department of Economics, Goenka College of Commerce and Business Administration, Kolkata, India. Our principal, Dr. Srikanto Samanto, convener this program, Sri Sakko Singho De, Assistant Professor, Navagram Hiralpal College, Dr. Prabir Dotto, Associate Professor, Sri Subhendu Kundu, Assistant Professor, Dr. Amarnath Das, Assistant Professor, Organizing Committee, Sri Kaushik Dari, Assistant Professor, Srimati Suparna Rai, Professor. So this time is a very important situation this time, and this program is very important for today's, because we know that all world situation is very bad position due to COVID-19, and banking crisis is the very most important things. So I thanks to everybody who arranged this program, especially organizing committee of Navagram Hiralpal College, Department of Commerce. Thank you everybody. I, Apurva Majumdar, President of Governing Body, Navagram Hiralpal College, hereby inaugurate the program and want to start the same. Thank you.
Thank you so much, sir, for your speech. Now, allow me to hand over the microphone to our respected principal, sir, Dr. Srikant Samanto, to deliver welcome address for the speakers and for all the participants. Sir,
Thank you, Subhashish. Good afternoon, ladies and gentlemen. I, on behalf of all Navagram Hiral Pal College, feel delighted to say that the various departments of the college have been organizing a webinar series of lectures during the last 6 months with much enthusiasm and fanfare. And an international webinar is being held today on contributing components to banking crisis and macroeconomic impact of COVID-19 by the Department of Commerce of the college. First of all, my heartiest welcome extended to Sri Apurva Mojumdar, President of the governing body of the college, who has just been kind enough to have inaugurated the international webinar. I welcome you, sir, to this webinar. Even a man in the street has come to understand that COVID-19 has caused an economic shock of unprecedented scale and scope by shutting down the sectors of global economy. Several questions may crop up naturally, like what are the economic impacts of the COVID-19 shock on macroeconomics and on banking sectors? Keeping all these questions in view, Dr. Kuntol Das, Senior Lecturer in Finance, University of Canterbury, New Zealand, South Asia Center, and Director, has benevolently agreed to act as one of the resource persons and deliver on this international webinar. He will speak on bonanzas, booms, and banking crisis. I warmly welcome you, sir. Namaskar. To this international webinar. In spite of your hectic academic and administrative busy schedule, you are with us today. I again welcome you, sir. Dr. Rajiv Bhattacharya, the second speaker of this international webinar. He is an associate professor of economics, Goenka College of Commerce and Business Administration, Kolkata. Will deliver on the topic economic impact of corona pandemic with special focus on Indian economy. I extend my heartfelt welcome to you, sir. I think this international webinar will virtually be a kaleidoscope of divergent views across the wide spectrum of macroeconomics and banking sectors. As you know, under the looming shadow of the pandemic COVID-19, when all the stakeholders of higher education, the learners, academicians, scholars, academic administrators are confined and staying safe at home, the Department of Commerce, in a series of webinars during the last 6 months, ardently feels it a part of our academic pledge and endeavor to live in the academic and intellectual endeavor in a single way. So I must welcome the members of the organizing committee, Professor Shakhu Sinade, convener of the webinar, Dr. Amarnath Das, Head of the Department of Commerce, Dr. Prabir Datto, Associate Professor of Commerce, Sri Shubhendu Kundu, and Sri Kaushik Dadi, Assistant Professors of Commerce, and Srimati Suparna Rai, State-aided college teachers in Commerce of the college. I also welcome the members of the governing body. I welcome Dr. Suparna Chatterjee, Coordinator, IQAC, Professor Rita Ghosh Choudhury Kaur, Secretary Teachers Council, to this webinar. I also welcome Professor Subhashish Borua, who is hosting this international seminar. I heartily welcome all my colleagues of the different departments and the participants from across the state, nation, and globe, and who are hailing from different departments. I once again welcome Dr. Kuntol Das and Dr. Rajiv Bhattacharya in advance to visit the college here as and when normalcy will regain. Namaskar.
thank you so much, sir, for your warm welcome address. It's been always pleasure to hear from you. Now, before proceeding to the speech of our resource person, I would like to hand over the microphone to Sri Shakko Singhode, convener and assistant professor of commerce, to formally introduce Dr. Kuntal Das and to accompany him to the microphone. And one more thing, participants are requested to drop their queries in the chat box. We'll be moving towards it once Dr. Kuntal Das concludes his session. Shakko, over to you.
Thank you, Subhasish. Good afternoon, all, and thanks for giving me the privilege to introduce such an elite person from New Zealand. Our first speaker today is Dr. Kuntal Das. Sir, am I audible?
Yes,
Yes,
quite
Sakko, you
audible.
are
Go
audible.
on. Go on, please.
Okay. Dr. Kuntal Das is a senior lecturer in finance at University of Canterbury Business School, New Zealand. He is also the director of the New Zealand South Asia Center at UC. Dr. Das has a PhD from University of California, Santa Cruz. He has been a consultant at the World Bank and has held research positions at the IMF, the Asian Development Bank, and the National Institute of Public Finance and Policy in India. Dr. Das is an editorial board member of the Journal of International Finance and Economics. He has published several papers in journals including the Critical Finance Review, Economic Inquiry, Emerging Markets Finance and Trade, Journal of Asian Economics, Journal of Economic Survey, and Review of World Economics, amongst others. Dr. Kuntal Das has been very kind to agree to be a part of our webinar series. Today, he is speaking on bonanzas, booms, and banking crisis. I hand over to Dr. Das. Sir, the platform is all yours. Sir, please.
Well, thank you, everyone. Good afternoon. It's almost good night here at New Zealand. But thank you for the warm welcome and thank you for inviting me to this webinar series. Before I start speaking, if I may share my screen. Is everyone able to see my screen?
Yes, sir. It is visible, sir.
Yes,
Yeah,
yes,
wonderful.
sir.
Wonderful. Thank you. So today I was asked to talk on this topic of banking crisis and in relation to banking crisis about bonanzas and booms. Well, I'm not only just going to, well, of course, it is quite important in the current scenario of what is happening with COVID-19 across the globe. But this has been a problem going back a few years, particularly also since the global financial crisis of 2008 and 2009. Recently, The Economist magazine had published a wonderful article warning basically all of us to think about the dangers around the globe with banking crisis. And it talked about if today's banks were run like they were in 2008, 2009, then we would all be in huge trouble. Okay. And I'll elaborate more on that. What was it going back 10 years, 15 years? How have things changed? And what are the immediate dangers the global macroeconomy is seeing today? To start with, because most of the audience, I believe, are from India, I would start with a few sort of current scenarios and problems facing the Indian banking sector. I'm sure most of you, if not all of you, are aware of the problems facing some of the banks. For example, the Yes Bank crisis that engulfed the Indian economy a few months back, right? Between 2004, for example, when it was launched, to 2015, so in a 10-year period, Yes Bank was one of the busiest banks in India. Okay. Then suddenly what happened that it went through a major crisis. Okay. If we look at the bank's balance sheet, its loan book on March 31, 2014 was around 55,000 crores and its deposits were around 74,000 crores. Since then, the loan book has grown nearly 4 times to 2.25 trillion as of September 2019. But the growth in deposits did not grow that much. It only grew by around 3% or so. So there has been a huge gap between the loans that the banks were giving and the amount of deposits and the assets that they were able to secure. Okay. So this also meant that Yes Bank suffered a dramatic doubling of its gross NPAs, that is the non-performing assets, between April and September 2009. So within a few months, its gross non-performing assets increased by around 17,000 crores. And what are non-performing assets? These are assets that basically cannot be recovered. So these are effectively things that are in default for the bank. So a huge amount of loss. Okay. And then RBI had to step in and had to impose a moratorium on the lenders. And I believe it was around withdrawal limit of around 50,000 rupees for a particular lender, right? So a really sort of bad situation for the Yes Bank. Now, it's just an example to show that things are going wrong, and we'll sort of through my talk, I'm going to go over some of the reasons what the problems are, and hopefully try to talk about some of the areas that we need to pay attention to, and hopefully some of the solutions that we have. But let me stress that this is a problem not just in India. Of course, I'll talk about India a little bit more, but this is a problem around emerging market economies and around many of the developed economies that you might or might not be aware of. Okay. So taking on the example from the Yes Bank, not only the example of that particular bank, but in general, the Indian economy has been facing a credit crisis. Okay, so there has been an emergence of credit crisis where officially the non-performing loan ratio is close to 10% now. Okay, so once again, non-performing loans means loans that have not been repaid for over 90 days and so on. So effectively loans that are linked to default. Okay, not only that, the ratio of stressed assets, which also includes restructured loans, has also increased, gone up by more than that to around 14%. So what all of these are suggesting is that the situation with the banking system is going into a situation where we should be really worried. If you compare it to the time of the global financial crisis of 2008, 2009, and I'm sure sort of most of you are aware, it started with the housing market crisis and bubbles in US, and then it moved on to many of the European economies that we call the GIPS economies, Greece, Italy, Ireland, Portugal, Spain, and so on and so forth. Even they, during the height of the GFC, did not have non-performing loan ratios as high as what the current situation is in India. Okay, so this is a little bit of a worry for the Indian economy. Just to give you a sense of where things are in terms of the different indicators that economists or a financial analyst would look at to see where things are going. This is looking at the time series graph of how the non-performing loans have behaved in India over the last, I guess, around 15 to 20 years, or a little more, around 25 years. So since 1996, 1997 that I had data for, you'll see at the beginning, since late 1990, it was quite high, around 13, 14, 15%. Okay, so actually the situation compared to the late 1990s, early 2000 was probably, it's still better, but you can see since that time it has come down to less than 1%, close to 0%. But since after 2010, 11, 12, after the GFC, this has again been climbing. So the worry is if we do not stop it, it is going to go up from 10% to even more and further, and that can create problems for the Indian economy. Okay, so this is one of the indicators in terms of the non-performing loans. How does India compare to, we always love comparing India to the other BRICS economies, Brazil, Russia, China, South Africa, and so on. So I'm not sure if you can see clearly all the different graphs. Okay, the high spike that we have just after 2000 was the situation of China, where the non-performing loans was close to 30% in the very early 2000. And look at China, that graph has come down to very, very low, under 5%, actually close to 1 or 2% currently, okay? Whereas India, which was not as bad, had actually gone up to around 10%, okay? Similar to what sort of probably Russia is right now. So compared to all the other emerging market economies that we like to compare them to, India is probably doing much worse relatively.
Hello, sir.
Yes.
Sorry for the interruption. Sir, your screen is not visible. If you kindly share it again, so that should be your convenient to our participants.
Oh, is it not? Is it
No,
visible
sir.
now?
Uh, no, sir.
Okay. So what I had, let me go back.
Sir, please stop the presentation and again restart the presentation. Means the option stop presentation and again you start the presentation. Then it
Start
will.
presenting.
So were you not able to see anything that I had
No,
spoken
no,
so
no.
far?
No, we have just now it's lagging.
Okay, okay. Is it visible now?
Yes, sir. Yes, sir.
Yes, sir.
Yes, sir. Thank you, sir.
Sure, sure, sure. So, sorry, I don't know where it, because I was talking about the graphs. So, were you able to see the NPL graphs for India?
Yes, sir.
Okay, okay. So, yeah, I was comparing the non-performing loans of India to the other BRICS economies. And so basically the point was that India is relatively doing much worse compared to its the other counterparts. Okay. Similarly, other kinds of things we try to look at in the Indian economy. Sorry, I'm getting an.
Please mute the mics.
Thank you, thank you. So other indicators that we try to look at to assess the situation of the banking system is what we call return on assets. Okay, so if you think of the banking sector and the assets of the banking sector, um, what are the returns on those assets? So banks, what they have when they have their assets, so they try to sort of invest, and the returns they get on that. Okay, so this is after tax percentage, and you can see from the graph how since 2010 it has steadily been going down, and now at sort of at a negative territory on the returns on assets. Okay, so banks are basically earning negative returns on their assets. Similarly, you look at return on the equities for banks, you would see a very, very similar story. Return on equities, we had a healthy return starting up in the late 2000, early 2010, and then since then going down again in the negative territory. So I think I have another indicator, bank net interest margin, that we try to look at. Okay, that is the interest margin. So banks make profit on the interest they pay you on your deposits and the interest they charge on their credit. So the difference is the net interest margins for the banks. And as you can see, those net interest margins have also been shrinking over time in the last few years, right? So all the indicators that we think of or look at to assess what is happening to the banking system for an economy is suggesting that things are going in a direction that might be problematic for the Indian economy. Okay. Now, why should we pay attention to this? Okay, why is the banking sector important? Okay, so if not anything, sort of, it is banks in most economies are the primary source of credit for both households and also for the financial sector. Okay. In developed economies, you have vibrant stock markets as well, but in most emerging market economies, the stock markets are not that developed. Okay. Even the domestic bond markets are sometimes not developed. So banking sector is the primary sort of vehicle through which credit flows. So firms borrow, invest, households get credit to buy different things, and so on. So that's the primary channel. So if the financial system is weak, that means it is going to bring problems for that entire economy as an ecosystem. Okay. We also know that when the financial sector gets into trouble, the real costs to the economy are very large. That means it's not only the banking sector that will be in a problem, the entire economy will run into deep recessions and what we call current account reversals. Okay. And just to give you a sense what this means, it's when we say deep recessions, on average, you can say next 2 to 4 years, it will reduce output by even more of to what we currently have, to around 8% to 10% of the GDP shrinking. Okay, so it comes with big costs. Okay, there are other estimates. It's not only GDP, investment suffers. For example, we have in history, for example, after the Asian financial crisis of 97, 98, countries like Malaysia, Thailand, they failed to recover their investment to the pre-crisis level even after 5 years. Okay, so 4 to 5 years investment is struggling to recover. And think of one of the primary channels of growth. If investment is suffering, the entire economy will be suffering. Okay, so you have output losses, you have investment losses, investment cannot recover. All of these will put immense pressure on the economy. Okay, we also have what we called how the government spends money in bailing these banking sector out. Okay, so the government has to, in order to save the banking system for collapsing, it will put in public money, it will put in public funds to recapitalize the banks. Okay, and these could be huge. For example, also to give you an example, in Ireland, we had around euro 135.8 billions invested into the Irish banking system after the global financial crisis in Ireland. Okay, so Ireland also faced a similar crisis, housing crisis going into banking crisis. So huge costs of that. Okay, so all of these should make us really worried that if we don't get our acts together, we would run into severe problems, not only in the financial sector, bringing down the entire economy from various perspectives that we have. Okay. This is another example to sort of give you some estimates of, as I said, it's not only a problem in India, but globally, just to give you an estimates of what kind of problems happened in different parts of the world. And these are looking at the different crisis scenarios of different countries, along with the cost to GDP as a percent of GDP shrinking due to this banking crisis. Okay. Particularly really badly hit was Indonesia after the Asian financial crisis. 55% of their GDP was shrinking at that time. Similarly, Argentina in 82, China in 1990s, and so on and so forth. You can see for many of those countries, we had easily 30 to 50% of the GDP shrinking due to banking crisis, as well as we have some countries where the effect was not big, coming down to around less than 10% or 5%. Okay, but whichever way we think of, it's a reasonably big chunk of a GDP collapse due to banking sector crisis that we have. Okay. Now, this is one aspect. The other problem that we as economists often think of is what, apart from this, what other problems can happen to the financial sector due to banking crisis. And what people often look as is what we called the twin crisis, or sometimes the triple crisis. Okay. So banking crisis, when it comes, it's not alone. It brings with itself currency crisis. That is, in the context of India, we would get a huge devaluation or depreciation of the rupee, as well as it brings the debt crisis. So Indian government's debt is going to increase, leading to debt restructuring or debt default, and so on and so forth. Okay. We also have what we call sudden stops of capital flows. Okay. We have foreign capital coming in, we'd have immediate stop of sudden capitals, and we have sudden stops and balance of payments crisis coming along with it. Okay. As well as we have what we call contagion effects. That is, if it gets into one sector with other countries that India has links in trade and finance, it will bring in problems of other countries into the banking sector, into the economy as well. Okay. So it is really, really important to see what's happening to the health of the Indian banks and the overall financial system for the economy. Now, what I'm going to sort of plan to talk a bit more today is going over some of the problems of the banking sector, but instead of focusing on all the different problems, I'm going to talk a little bit from the research that I have done in two particular areas. And I'm going to focus some of my, and tell you some of my research on those two areas of banking sector crises and problems, and then probably talk a little bit more about what are the other situations. Okay. And probably I should, it's fair of me to say that this is not just my individual work. I do a lot of collaborative work with other people. So I should acknowledge their contributions in the research as well. Okay. They are both in sort of in New Zealand, in US, in Europe as well. Okay. So just acknowledging them as well. So the two aspects I'm going to focus on today in this talk are first on the competitive behavior in the banking sector. Okay. And what I mean by that is whether a competitive banking system is good for the economy. Okay. Some people have a view that maybe competition among the banks is good for the economy. It's more efficient. Some people are of the view that no, less competition is probably beneficial for the economy. So I'm going to shed a few light on what is it? Is it more market power is good for the banks? Is it more competition good for the banks? And what incentives do they create for risk management and supervision issues in the banking system? Okay, that's one aspect I'm going to look at. And the second aspect I'm going to look at is, due to the globalization, what are the risks that comes in with the international flows of investment, international flows of funds? How risky are those to the financial sector, and what kind of problems have they created for the banking sector? Okay, so these are the two kind of main focus that I am going to have in my talk primarily, and then talk about a few other things at the end. Okay. Now, well, I have talked about the banking crisis so far, but when we do sort of careful empirical work, looking at trying to establish a causal relationship with different indicators, what are the problems, and so on and so forth, how do people go about measuring what we call a banking crisis? Okay, when do we know that the economy is into a real mess as and into a real crisis. Okay, there are different definitions and there are different indicators that I have spoken to. In general, people think significant signs of financial distress in banking crisis is when there are significant losses that comes in the banking sector. Okay, and what can be losses in the what can be those significant losses? Typically there are different benchmarks people play around with, but typically when non-performing loans are above 20% of their total loans or bank assets, then we feel that it's really bad. Okay, so if you think of the figures for India right now, it's still half, it's around 10%, and it seems bad, but we would still not be calling it into a severe crisis mode. There are still way to go, but if we don't stop it now, it can go into an exponential mode and get into those crisis kind of a situation. Okay, so that's one thing. Okay. Secondly, it's not only that the banking system, the assets or non-performing loans are higher. Sometimes the government will step in with policy interventions in order to stop that. And sometimes these policy interventions are huge. And because of that, we don't see substantial losses which are artificially hidden because of these substantial policy interventions that we see from the government. Okay, so we do also have to keep an eye on what the government is doing to the banking system, and are they trying to hide what the real problems are. Okay, and when do we see that? When we see that the deposit freezes or bank holidays, for example, when we see there are significant bank nationalizations that are happening, when we see there are significant bank restructuring fiscal costs, okay, which maybe at least 3% of GDP or more than that, when there are extensive liquidity supports that are provided to banks, significant guarantees in place, or significant other sort of types of asset purchases that the government does to bail out these banks. Okay, so any of these type of acts by the bank to actually, the government to bail out banks are also indicators that the banking system is going into a severe problem. Okay, so we do take into account all of these to evaluate when the banking sector is getting into a crisis. Just to give you a sense of, if we think about these different parts of or different policy interventions and resolutions that come into place, you can see we have deposit freezes, bank holidays, guarantees, liquidity supports, all of that. Primarily that happens is between either asset purchases or recapitalizations or liquidity supports or bank guarantees. Okay, so this is showing you these are the majority of supports that are provided in sort of high income countries or the low and middle income countries, okay, which we like to call as the emerging market economies nowadays. Okay, so that's the primary bulk of where how the government is intervening to safeguard the banking sectors. Okay. Now, one thing, as I started with saying, giving sort of talking about India per se, but you won't be surprised to see that the problem is not just in India. Okay, this map gives you a rough indication of the prevalence of banking crisis in the last 45, 50 years around the globe. Okay, and as you can see, even from developed countries in North America, so US, Mexico, in the whole of Latin America, most of Europe, okay, parts of Asia, definitely, most of Africa, just leaving around the MENA countries that we would like to call in Middle East and North Africa, probably less so. We haven't had it in Australia, New Zealand, but apart from that, most of Latin America, Asia, Europe, North America has gone through crises, okay? And you can see the worst performers, Argentina has had banking crisis 4 times or more. Okay, similarly bad situations in parts of Europe, parts of Africa, and so on and so forth. Okay, so it's a global problem that we have, not just in India, that we see. Okay, breaking it up into a little bit more, is it just the poor and low middle income countries or the high income countries? As you see, of course, the prevalence is more in low and middle income countries, but also lately particularly after the GFC of 2008, 2009, we see high income countries also facing huge banking crisis. And I'll talk about it a little bit later. That has to do with capital flows that comes with different kinds of asset bubbles and housing price bubbles that we see in these markets. Okay. Third, as I said, one crisis brings with it other types of crises. You can see banking crisis with it brings currency crisis, debt crisis, all of them come together. So the twin, triple crisis coming together. Okay, so the problem gets expanded more and in an exponential way it grows when all other different types of crises come in together that we have. Also looking at what happens to government debts in these countries. Okay, looking at both high income countries and low and middle income countries, you can see the increase in public debt as a percentage of GDP keeps increasing. Okay, probably a little low on the left hand panel. High income countries probably less than 45%, between 30 and 40%, whereas it's easily 50%, 60% for the low and middle income countries. Okay, so government budget also really blows off when we see a banking sector financial crisis coming in. So the economic costs really are problematic. Right. So with this in background, let's try and assess the two different ways of thinking about our sort of major ways of thinking about what could be the problems as well as what could be one of the solutions in terms of thinking about stopping the banking sector crisis. Okay. Now, there were sort of two popular beliefs, particularly after the global financial crisis. Okay, so things were really great since the 2000 with GFC, many of the developed countries having banking crisis, so on. We had already had Basel 1, Basel 2 in terms of the reforms of the banking sector. We now have Basel 3 with more macroprudential policies. But behind that were sort of two different kinds of arguments. Okay, one, the government support, one idea or one popular belief was that government support of largest banks reduced competition and contributed to the instability in the banking sector. Okay, so why were banking systems failing? Why were banking systems unstable? One popular belief was government was supporting the largest banks, and those banks were thought to be too big to fail. And that's why they did not do their due diligence. And that's why, due to reduced competition, that was creating instability in the market, in the banking sector, and banks were failing. Okay, that was one view. The other view was increase in competition and financial innovation in the market, such as subprime lending, contributed to the financial turmoil. Okay, so we had different types of financial products that were being innovated. So we had a huge list of derivatives markets that were leading to all kinds of subprime problems that led to moral hazard problems. That means it was no one's problem. One problem was being passed from one person to the other person, one institution to the other institution. No one had any accountability of what was happening with loans, what was happening with their assets. And that moral hazard problem led to failure of the financial systems. Okay, so we are going to spend a little bit time in trying to understand what these arguments mean and how true are these. Okay, so in particular, what I'm going to, or what we have looked at in our paper is, does banking competition, if we have a banking sector competition, that means allowing more and more banks to come in, increasing the competitive behavior of the banks in the financial sector, does it make banking crisis less likely? Okay. Or is a concentrated banking system better for an economy? That means if we have few larger banks in an economy, does that create more stability? Okay, which one out of these are more stable? And what are the roles of different kinds of banking structures and supervision, etc., on banking crisis? Okay, so that's what we are going to we have trying to look at in our paper. Okay. Now, as I said, there are different types of theories in thinking about which creates more stability. Okay, on one hand, what we have is what we call a concentration stability theory. Okay, What does the concentration stability theory says? It says few large banks are good for an economy. Why is that? Number one, you can think of it as a few, if there are only a few banks in the economy, they will have greater market power, they will be more profitable. Hence, there will be less incentive for risk taking. That means they will not lend out to people to seek for risky returns. Hence, their NPLs would reduce. Okay, that's one argument. Another argument is if you have few large banks, they are easily monitored by regulatory bodies. Hence, effectiveness of supervision and regulation will happen in the economy. Okay, few large banks, it's easy to monitor what they are doing. It's easy to monitor how they are spending their loans, what is happening to them, how they're giving out credit. So they could be easily monitored, hence more effective. Okay. Another argument is a few large banks are in a better position to assess default risk themselves. So banks do due diligence, and once they are profitable, if they are large banks, they can do more due diligence. Hence, they can counter what we call adverse selection problems. That means they will not lend out to risky investors. Okay. And there is another argument that says concentrated banking systems can diversify more easily than a large number of smaller banks that are more susceptible to foreign adverse shocks. Okay, if we have a global shock, then if you have a large number of banks and if the banks are small, it becomes difficult for them to withdraw or sort of protect themselves from those shocks, whereas a few large banks will be able to protect themselves much better. Okay, so there are different kinds of arguments for why a few number of concentrated banks are good for an economy. Okay, there are also people that look on the other side and say, well, no, a few large banks will make the systems more unstable, and we need more competition in the banking sector. We need more foreign banks coming in. We need more and more banks to operate in the economy. That will the loans would be cheaper to get, and hence it might be better for the economy. Okay, so what are the different arguments for it? That moral hazard issues, when given too much market power, increases when we have too few banks. Okay, if the banks are too few, they know that whatever they do, governments will bail them out. So they might not actually do due diligence, and hence they might actually be taking more risky ventures. Okay. On the other hand, because they will have a more of a monopoly or monopolistic power, banks can charge high interest rates. Okay, so firms that are borrowing from these banks at a higher interest rate will have no option but to undertake riskier projects, and hence their stability, their investments might fail, and hence the banking sector stability might reduce. Okay. We can also think of greater banking system competitiveness would reduce the bank's soundness and drive banks to embark upon riskier investments. Okay, so a similar kind of argument. And there have been some arguments making if the countries have a greater threat of competition, then banks are less likely to have, or the countries are less likely to have a credit bureau, and banks are less willing to share information to the credit bureau. So when they indulge, when there are a large number of banks, information gathering and doing due diligence, doing due monitoring to these banks become more and more difficult. Okay, so do you have options or sort of arguments going along on both sides that we see? Okay, now there are different I'm probably going to skip due to guessing we might sort of run out of time. So given this time, what I'm going to show is looking at these different aspects. What we do sort of some empirical analysis of why what might happen when we have these different kinds of concentration versus competition with all the different regulatory instances happening, and what has happened in terms of the banking stability. So I'm going to sort of skip a few slides where we look at different indicators of bank competition. Okay, so there are different indicators available that we look at: the age statistic, learner index, Boone indicator, net interest margin, and a whole lot of other indicators that I have talked about. We look at all of these indicators and regress it on these different competition concentration variables. We also take account of the different activity restrictions on bank competition, what are the different levels of entry barriers that they have, what are the different kinds of capital regulatory index that they are facing, all of them taken into account. Okay, I'm probably going to skip my regressions as such and give you a summary of what we find. Okay, so in summary, what we have found in sort of going through different econometric analysis is that the concentration stability theory holds strongly. What it means is, probably for most economies, it's better to have few larger banks than have a whole list of too many banks, and we have no clue what these banks are doing. We cannot monitor them, we cannot supervise them, and hence they can be doing whatever they want with their loans in order to increase their uh, profitability and increasing sort of seeking for a risk-taking behavior. Okay, so we find a very strong support for a large few banks than a more competitive banking sector with a whole lot of banks. Okay, and these I didn't have time to go show you all the different results, but these results are robust across different kinds of specifications, across different types of indicators and etc. that we see. Okay, so that's the bottom line of what we find in our research, number one. Okay, the second part related to this is, when we think of globalization, when we think of it's good to open up the economy, we have different kinds of investment flows coming in. What kind of impact would it have on the banking sector? Okay, and more it comes in through the different competition variables that comes in, and also the nature of capital flows that come in with these flows. Okay, so what we look at is dissect the different kinds of international capital flows. So we look at foreign direct investment coming in, we look at portfolio equity flows, we look at debt flows, we look at banking flows, and see what kind of flows are riskier for that economy, and are they risky for the economy, and why, and what are the channels through which it happens. Okay, so we do see when institutional framework is weak, international capital flows can lead to what we call asset bubbles and thus financial crises. Okay, so while it is important that we do have foreign capital coming in, we also need to be aware that that will increase the stability of the financial system if our institutions are weak, number one, and number two, if we don't pay enough attention to how that foreign capital is being invested in terms of credit. Okay, the bottom line is, once credit comes in through different forms, the banks it's find is as a bonanza. Okay, so I'll skip a few slides to show you. So what we term as bonanzas are the sudden inflow or surges of capital flows. Okay, and what is the problem? Think of it as an individual. Like, we have a steady flow of income. Suddenly, let's say an individual wins a lottery. Okay, what happens if we win a lottery and we suddenly have a lot of capital coming in? We think, oh, now we have a lot of money, let's spend. Okay, what it means for the banking sector is that when they get these surges in capital flows, what it means is they are giving out loans to people that are not advisable. Okay, so what it means is that can lead to what two types of asset price bubbles. Okay, it can lead to bubbles in the stock market, it can lead to bubbles in the housing market sector. Okay, or house price, what we call the house price bubbles. So both due to these foreign capital inflows, we have credit inflows, we have credit booms that lead to asset price bubbles, that lead to housing price bubbles. and then in turn it leads to a banking sector crisis through this. Okay, so I've summarized my sort of different what we go over uh, in my result to give you just a sense. Okay, and when we look at the different kinds of flows, we do see that debt flows and other flows, which are essentially most primarily the banking flows, are the most risky kind of inflow components. Okay, we do see FDI flows are somewhat risky, but we didn't find portfolio equity flows to be that risky. Okay, and we do find these the different credit boom channels and asset price channels to be really important in destabilizing the banking sector. Okay, so these were sort of we have done sort of some extensive research on these two areas. Okay, so just to conclude, I think probably have almost running out of time. To conclude, what are the other considerations along with it in terms of thinking about what are the things that we should be aware of, particularly for developing countries or emerging market economies like India? They have increased their sort of minimum capital requirements to help curb these risks, but greater information disclosure and supervisory capacity are needed to prevent these banking sector problems. Okay, and secondly, we need effective regulation and supervision. Okay, not only information disclosure, but based on that, we need our regulation and supervision to be effective. Okay, so that they harness the market discipline and curb these excessive risk taking by the private entities, the investors, as well as the banks giving out these loans. Okay, so we need effective supervision to control that. Okay, thirdly, these bank regulations that are coming in, they need to be compatible with incentives, and but in some sense, this is the problem. The way we design the policies and the incentives that we provide are sometimes not are incompatible. And in with sort of more opening up of the economy, it becomes more and more difficult to actually balance that. Okay, and the more we open up with more globalization, more technological change, it will become more and more harder if we don't pay attention to these things. Okay. And sort of finally, to conclude, in the context of India, the problems that we see on top of that as sort of the primary issues, we have other local problems in India. Okay, so first of all, we have the rural branches in India that are making losses, and particularly after this COVID pandemic, we can see that is going to increase much more now after that. The non-performing assets that we have, most of them are also unable to maintain this minimum capital adequacy ratio that we think the banks would have to require to maintain that balance. Okay, that will be even more problematic. Okay, we have advances to priority sector. The Indian banking sector have not got its act together to be able to prioritize lending to the really needy sector, and those are aggravated because the loan recovery rates from the small sectors and the agricultural sector has been really poor. On top of that, to aggravate it, we have competition from the non-banking financial institutions, so hedge funds, mutual funds, and so on. A lot of competition is being given to the banking sector from these financial institutions. So these banking sectors are going to be even more stressed out. We have competition from foreign banks as well. Okay, and to add to it, the problems with our bureaucracy and political pressures. Okay, so the banks are not left alone to think in terms of their governance structure and the kind of political pressures they are subjected to. So all of this will unfortunately add to the otherwise problems that we face. So unless we can sort of take some steps in order to avoid this, we are likely to see problems going down the road. Thank you.
Thank you so much, sir. Now the question answer session, and to chair the session, I am inviting Dr. Amarnath Das, Assistant Professor of Commerce and Head of the Department of Commerce. Amarda, please.
Thank you, Subhasis. Sir, I do have some questions. I mean, I collect some questions. The first one is, how banking crisis is associated with currency crisis?
Well, Good question. So banking crisis is associated with currency crisis because of banks' balance sheets. Okay. So the problem is for most of the emerging market economies, most of these sort of a part of that lending is in domestic currency, but when banks have to borrow money, they have to borrow in international currencies. Okay, because the domestic bond markets or even the domestic finance sector otherwise are not developed for most of these emerging market economies. So when their balance sheet, they have their sort of the liability sides in foreign currency and their assets in domestic currency, there is a asset mismatch in terms of these currencies. So once you see a problem with the banking sector, and if foreign capital when goes out, that leads to even more problem with the currency. Okay, because that will put pressure on the exchange rate, and also vice versa. The exchange rate devaluation or depreciation will simultaneously cause more problem on the banking sector's balance sheet on the liability side. Hence, that increases the probability of a crisis.
Sir, next question is government bailout banks in is an indicator of some problems is prevalent.
Sorry,
So would you give some example?
can you repeat the question again?
Government bailout bank. Yes, yeah, yeah. Government bailout banks is an indicator of some problems. I mean, there is some problem. Otherwise, government can never comes to bailout. So
Absolutely.
the question is, could you give me some practical example?
Yeah, as I said, so in when we think about how do we know that the banking sector is in a mess, one of the indicators of banking sector being in a problem is when the government has to step out to bail out banks, because in most countries we have the government do not want their banking sectors to fail, right? So it has, as I said, problems for the entire economy because there will be recessions in the economy and a crisis in the economy going from the banking sector to the entire economy. Not only that, that brings in huge political pressure, right? No government will want to have their major banks fail, because that will lead to problems. So when the governments are stepping in to bail out banks, okay, they are protecting the depositors from failing, which indirectly means the banks by themselves are incapable of doing it. And most of the examples that I showed you earlier, biggest example was in Ireland. It happened in US, it happened in many developed countries, in the European countries, as well as most of the emerging market economies. That's one of the primary indicators of when the government is stepping in, we do see, we know that the banking sector is in a problem. You're muted. Sorry, I can't hear you.
Am I audible, sir?
Yes.
Contagion effect explain possibility of spread of economic crisis or boom across countries. I just want to know what are the parameters to count or to measure this kind of possibilities. Is there any parameters? Definitely, it should have.
Yes. Well, there is no one indicator that we have, and contagion effects are, well, exposed, like after it has happened, it's easy to identify, but it's one of the most difficult things to predict as such. Okay, so people have done extensive sort of looked at different ways of how integrated are the financial markets in the different countries, and what are the asset positions of the different banks, and how exposed are they to these different currency risks, or how integrated are they to these capital markets. Okay, so when you know these capital markets are integrated, then you know it is likely that if it gets into one sector, There are going to be sudden stops. There are going to be capital outflows of those economies. And if it happens in one country, it is going to happen in the other countries. One of the biggest examples of this is the 1997 Asian
Okay.
financial crisis that happened in 2008 as well.
One last question. Uh, Asset price boom due to foreign direct investment contribute banking crisis. Could you explain? I mean, in 2 or 3 lines.
Yes. So in short, what sort of any kind of capital flows does is when you have, for example, these direct investments coming in, okay, so they have to be channeled through something. And what often it happens, it goes to one sector of the economy, and then it's like having a bonanza. So by itself, foreign direct investment is not a problem. But if we have a sudden increase, okay, if we have too much that comes in all of a sudden, that can lead to other financial sectors taking advantage of that, because somewhere money is flowing in the economy. That will lead to a credit spree. That means everyone wants to sort of lend it out at cheaper rates without understanding where to lend. That gives to these bubble creation in the economy, and that primarily goes into either the stock market or the
Many,
housing
many
prices.
thank you, sir. I just hand over Professor Sakho Singode. Sakho, hello.
Yeah, Subhasis, please take over from here.
Yes. Thank you so much, sir, for spending so much time with us, and thank you, Aman Nadda, for chairing the session.
Thank
Well,
you.
now we are in the second half of today's session, where we are fortunate to have with us Dr. Rajiv Bhattacharya, Associate Professor, Department of Economics, Goenka College of Commerce and Business Administration, Kolkata. Before Dr. Bhattacharya delivers his talk, I'm going to hand over the mic to Sri Kaushik Dari to formally introduce and invite Dr. Bhattacharya to commence his talk. Kaushik Da?
Thank you, Subhasis. Am I audible, Subhasis?
Yes, 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 yes. Please go on.
Thank you, Subhasis, and thanks to Dr. Das for his enlightening and informative deliberation. Now, I am very honored and extremely privileged to have among us Dr. Rajiv Bhattacharya, Associate Professor, Department of Economics, Goenka College of Commerce and Business Administration, Kolkata, India. Dr. Bhattacharya will deliver today on the topic of macroeconomic impact of corona pandemic with special focus on the Indian economy. Dr. Bhattacharya has contributed a good number of articles in reputed national and international books and journals like IGI Global USA, Emerald UK, and Taylor's and Francis Springers and others also. Dr. Bhattacharya has been awarded the best paper presenter in an international seminar on recent trends and perspective in economics on January 2016. He has also served as an invited reviewer in Indian Economic Journal Research Publication for Trade Review, Journal of Asian and African Studies, International Journal of ICT, Research and Development of Africa, and many more. Now, we are happy that Dr. Bhattacharya has been agreed to deliver his valuable lecture in this webinar. So, without much wasting of time, I am now requesting Dr. Bhattacharya to start his deliberation. Over to you, sir, and the platform is yours.
Hello, am I audible, Kaushik?
Yes, sir, you are audible, sir.
Yes. Good afternoon, everybody. Thank you for allowing me the opportunity to speak on this webinar. Actually, I am going to speak on the second aspect of the seminar, the second part, that is the macroeconomic impact of the corona pandemic, with special focus on the Indian economy. The platform has been made easier to me because Professor Das has elaborately and in depth done his analysis on the banking sector. I hope an economy has two parts. One is the real part, and another is the financial part. The real part is open to me, and the financial part has been done in depth. So before going to my presentation, let me first respect the principal, Dr. Shamanto of Navagram Hilalal Pal College, convener Dr. Chokko Chingode, my co-speaker and my earlier speaker, Dr. Kuntal Das, other dignitaries, teachers, friends, students, and all other present in this webinar. I would first like to convey my heartiest thanks to the organizing committee of the Navagram Hiralal Pal College, and in particular Professor Kaushik Dari, Assistant Professor, Department of Commerce, who happens to be also my research scholar, for inviting me to share my ideas on this topic, which has been the highlight of the discussion over the last few months or so. Now, in my lecture, what I have done, what I will do is, I will go a little bit non-technical in nature. It will be non-technical in nature in the sense that it will be in the PowerPoint form of PowerPoint presentation. And it will be based on the reports and findings of various world institutions like the World Bank, the OECD, the UNCTAD, the World Development Report, the WTO, and in case of India, I will concentrate on the Ministry of Commerce and Industry, the Center for Studies, Center for CMIE, the Director General of Foreign Trade, Economic Survey, and so on. So I actually can I share my presentation, Kaushik?
Yes, sir. You can share, sir. Yes, sir.
Please let me know whether it is visible.
Yes, sir. It is.
Is it visible?
Yes, sir. Yes, sir. Visible, sir. Visible.
Yes. So I will be speaking on this, I have already said. So without wasting much time, let me tell you the structure of my presentation. I will briefly introduce COVID pandemic as a health catastrophe, and then I will touch upon the economic and the social impact in brief, firstly. And then I will go to the main part of my presentation, that is the macroeconomic impact on various indicators. I have taken up the global as well as the India's output, particularly the GDP, variable impact on the various sectors of the economy, the impact on the labor market, the impact on the international trade. As you have already listened to the lecture, there are various aspects of trade which has become prominent in recent times, particularly the India-China trade relationship, the self-reliance and the Atmanirbhar Bharat issue, and also the impact on the education, which has now become prominent. We are now on the online platform, so the debate between traditional and the online education. Some positive signs of recovery which have cropped up in recent times from July, August, according to the recent surveys which have been taken by the government of India, particularly in respect of manufacturing, capital flows, and the growth of foreign exchange. And last but not the least is the revival policy. Now, let me start with a caption which has been the caption of a magazine, which says that since the beginning of the 21st century, recurring outbreaks of pandemics has actually been in focus in recent times. Starting from the SARS outbreak in 2003, H1N1 influenza pandemic in 2009, the MERS coronavirus in 2012, Ebola from 2014 to 16, mosquito-borne Zika virus in 2016. But quite different from this is the COVID pandemic. We are using the term pandemic, not an epidemic. So the spread, the geographical spread, and the alarming way in which this disease has spread, it has already proved that this kind of pandemic can be more fatal than the devastations of a war. It has really brought challenges, shown challenges in front of the mankind. The biggest challenge, in fact, is definitely life versus livelihood challenge. And we all know that it has brought a new changing structure in front of the world. The world has changed a lot in this last 6 months or so. It has brought significant changes in the structure of production, in the structure of consumption, in the work pattern, in the way we read, write, study, and the educational environment, and so on. But in this respect, one must note that the infection rate of the COVID appears to be more severe than the SARS and the MERS syndrome, which appeared in 2003 and 2012, respectively. Now, let us concentrate, let us see this gradual, the chronology of the spread, how the coronavirus actually spread in India over time. Here is a small figure which shows recent updated up to 31st August, which shows from starting from the March to August 31st of 4 phases of lockdown and then the unlocking periods, how the coronavirus actually spread in India. There are various indicators being used there, active cases, recovered cases, and so on. One must note that India reports to be the third, now it is the second highest after the US and the Brazil. And if we look into the active cases, that actually fell to 1.65% in 31st August as compared to 3.12% in 31st July as the recovery rate increased. Now, due to this increase of the recovery rate, the active cases has grown slower than the total confirmed cases. But one must also note that over the last 40 days or so, India has occupied the number one place in the daily rate of infection throughout the globe. And the infection rate rise in the region 95,000 to 98,000, which is really alarming. Now, before coming into the next slide, which tells us about the first impact of the macroeconomic crisis, that is the impact on output, let me briefly touch upon the background scenario. Now, COVID-19 pandemic has already started. We know a devastating blow to the already fragile global economy. The pandemic has spread at an alarming rate, and the infection has infected millions of people, bringing economic activity to a standstill in many countries, and it has compelled countries to impose tight restrictions on the movement, and it has also induced a halt, tried to halt the spread of the virus. As the health and the human toll grows, economic damage is already evident, and there is no doubt, no denial of the fact that it is one of the largest economic shock that the world economy is experiencing over decades. Now, if we look into the long-term perspective, the long-term horizon, we will see that the deep recessions that is triggered by this pandemic are expected to leave long-lasting scars. Now, through what channels? The channels are lower investment, an erosion of human capital through lost work, and also the problems, the closure of schools and colleges and higher education, fragmentation of global trade, the disruption of supply linkages, and this may hamper the long-run future potentiality of growth and productivity in the longer term. This is particularly more prominent in emerging and developing markets who have a weak health systems, and they rely more on global trade, tourism, remittances from abroad, and also depend on commodity exports. These countries are particularly hard hit. So what is the need of the hour? There is a need for urgent action to cushion the pandemic's health as well as the economic consequences of the crisis, particularly to protect the vulnerable sections of the population and set the stage for lasting recovery. So what we need is a comprehensive reform package to reduce the adverse impact in the long run and improve, and can be done in terms of governance, business environment, expanding the investment in education and public health. Now, if we look into the data, the latest data which I have with me is the World Bank's data, global economic prospects, as you see. And global economic prospects of the World Bank tells us that irrespective of the country concerned, maybe emerging markets, maybe of East Asia Pacific, maybe Europe, Latin America, Middle East, South Asia, Sub-Saharan Africa, irrespective of the country, maybe advanced countries. All countries actually has experienced a severe decline in the growth of the GDP. Now, if we look into the US economy, that is going to contract by 9.1%, the UK by 21.7%, the France by 18.9%, Spain by 22.1%, Italy by 17.7%, and so on. The euro area is going to contract by 15%, Japan by 9.9%. Why I am saying this? Relative to these advanced nations, these predictions suggest that India's GDP is going to contract by 23.9%. Can you imagine? The much higher than the other countries. It's slightly higher, and the explanation that has been put forward by the government is that the government response stringency index, which has been developed by the Oxford University, they say that India has imposed the most stringent lockdown, and that is that contraction of the GDP with 23.9% is due to the result of the most stringent lockdown. And what this lockdown has enabled is to restrain the pandemic and to induce and to reduce the death rate to the lowest in the world. And as it is being claimed, that fatality rate in India is 1.78% as on August 31st August, which is much lower compared to the US, and which is 3.04%, and compared to UK, which is 12.35%, compared to France, which is 10.09%, compared to Japan, which is 1.89%, compared to Italy, which is 13.18%. So what this stringency of lockdown has done has been represented by means of a chart which shows, the first column shows the government response stringency index, which is index between 0 to 100, and you can see the India's index is of the level 85.6. You can see it, which is the highest among all the countries that has been shown here: Canada, France, Germany, Italy, Japan, Spain, UK, US, China, Brazil, and many others. So this kind of lockdown, actually this stringency government response stringency index, which points out one more interesting thing, that is, if we try to find out the correlation between the intensity of lockdown and the magnitude of decline in the GDP among various countries, we find there is some kind of positive correlation. That means that intensity, as the intensity of lockdown increased, the GDP growth actually declined more on those countries. And India's 23.9% decline is consistent with that part of the correlation, as it has been pointed out. The lockdown period gave actually a respite to ramp up the health and the testing infrastructure of the country. Now, let us move on to the next survey, which has been conducted by the RBI. The survey of professional forecasters and macroeconomic indicators, the 65th round survey, July 6 to 27, which shows that various indicators, this year there will be a shrinkage, and next year they predicted a revival. Let's start with the real real GDP. It is expected to contract by 5.8% this year and recover by 7.4% next year. Real private consumption expenditure is going to contract by 6% this year. It is going to expand by 8% next year. Real fixed capital formation is expected to decline to a record of 9.8% this year and is going to projected to improve by 6.8% next year. And forecasters have predicted that the probability of growth rate lying between minus 6.0 to minus 5.1 is the highest for this year, and the probability for the growth lying between 7.0 to 7.4 is the highest next year. Though there is a real gross value added is expected to decline, but the agricultural and the industrial and service sector activities are also expanded to expand next year. Now, with this, let me move on to the sectoral impact of this COVID-19. Now, sectoral impact is being determined by which sector is more affected. Not all the sectors, you can see, they are used, the different colors are used by the ILO. This is the International Labour Organization estimate, which shows that the manufacturing, the wholesale, the retail, the real estate, the business and administrative activities, the accommodation and the food services are the highest sensitive sectors which are highest affected by this COVID pandemic. And the share of employment in these sectors are almost close to together from almost 30 to 35%. So you can imagine that how much labor are being retrenched from their job, they are thrown out of their jobs. Then come the medium high affected sectors, the art, the entertainment, the recreation, the transport, storage and communication, the medium high affected. Then comes the medium affected, construction, financial and insurance services, mining and quarrying. Then comes the low medium affected, where a majority of the people employment is being absorbed, the agriculture, forestry and fishing. Then comes our sector, the education, the human health, social activities, public administration, defense, and utilities, which are low affected. Let's from this slide move on to see the global impact on the job scenario, the job market. As we all know, this health shock has already transformed itself into a labor market shock. And this labor market shock has deep and far-reaching and unprecedented impact on the labor market. And not only it has resulted in a decline in the employment, but also a reduction in the work hours, and almost 80 to 90% of the global workforce are affected by these closures. The employment layoff and the reduction in the work time has affected the salaries and the wages and the payments of the lower and the middle income, particularly in the context of India. The informal sector or the migrant workers are thrown out of their job. That has posed a great question to their livelihood. The ILO estimate by McKibben and Fernando 2020 suggests that three scenarios are possible in employment. One is the low, second one is the mid, and third one is the high scenario. The low scenario case is expected where the GDP is expected to reduce by 2%, unemployment is going to rise by 5.3 million with an uncertainty of 3.5 to 7 million. In the mid scenario case, GDP is going to drop by 4%, where the unemployment is going to is going to increase by 13 million with an uncertainty of 7.7 to 18.3 million. And the high scenario case where the COVID-19 has more disruptive effect, the GDP is going to reduce by 8% and the global unemployment is going to increase by 24.7 million with an uncertainty ranging from 13 to 36 million. Now, let us move on to the latest edition of the ILO, which tells that if we move into as we are proceeding more and more, the days are passing by and the closures are more and more implemented, more and more workers, almost 93% of the global workers are being affected by this close down. And not only that, as this in the compared to the first half, the second half, there are more severe implications of this lockdown. And if this effect has been disproportionate, affecting more to the women workers, and the risk of losing some of the gains that have been made in the recent decades have been lost, and it has also accelerated gender inequality in the labor market. And the recovery is expected in the second half, is expected to be uncertain and incomplete. The left-hand side figure 2 points out that compared to the first quarter, in the second quarter, the loss of working hours are more severe compared in all countries, irrespective of the country concerned. If we take up this figure 3, the change in employment between women and men ages 15 plus in selected countries. The countries are Australia, Canada, Colombia, Japan, Korea, United States, and all. We see that irrespective of the country concerned, we consider the year-on-year changes April 2019 to April 2020, we will see that the deep blue line shows the changes for female, which are more severe compared to the male, irrespective of the country concerned. So there is a gender bias and it has exacerbated gender inequalities in the labor market. Now, these are global things. Now, let us come to what has happened in India. Compared to the prior to the corona situation, a beautiful work has been done in Ajinji Premji University, Mehrotra and Farida. They talk about that Indian economy has already been passing through an unprecedented decline in the unemployment trends if we compare the scenario in 2011-12 to that of 2017-18. And they say that across all levels of education, you can see illiterate to primary to secondary to middle to higher secondary to graduates to PG to technical to vocational and all education levels, youth unemployment has actually increased in 2017-18 as compared to 2011-12. And due to this decline, that has been due to the decline in the agriculture and the manufacturing and the slow growth of construction jobs and the process of structural transformation which gained momentum in 2004-5 but has been stalled in 2012. And the mounting educated youth unemployment and also the lack of quality of non-farm jobs has also resulted in the disattainment of the labor force in this sector. Now let us take the situation after COVID. After COVID came, what the CMI, Center for Monitoring of the Indian Economy Private Limited, they came up with various statistics. I have taken up three. The first figure, the left-hand side top figure tells us the change in the unemployment rate. You can see a sharp increase. What happened? Can you see? Or is it not visible? Hello? Hello?
Hello, sir.
Is
Hello,
it
sir.
visible? Is it visible?
No, sir. Please, sir. Once again, you, sir, present your screen.
Okay.
Others are requested not to present their screen. Please do not present anyone's screen. Please do not present your screen.
I,
It
I
will
got
have.
the message from the screen that your presentation has stopped. So that's why I'm
Sir,
asking.
sir,
Yes, sir,
first of
someone else
all, you,
started presenting something.
And that's the problem in this kind of
yes, sir.
webinar.
Yes, sir.
So that actually distracts some concentration and time also. Okay,
If
fine.
someone else is presenting, that's why it might stop your presentation. You may resume now, sir.
I know. So that's really a problem.
Okay.
Yes, sir.
I think now it is visible again. Okay, is it visible?
Yes, sir.
Yes, sir.
Yes, sir.
Yes,
Visible,
sir.
sir.
Yes,
Yes,
please.
yes. So I start from the slide where I left. Okay. So you can see the hike in the unemployment rate from March 20, it was 8.75, suddenly it jumped to 23.52. And in the next month, again 23.48. After that, it actually moderated and came down. So there was a sudden jump due to the COVID, and during that period there was the intensity of the spread of the pandemic was going on at an alarming rate, and it was spreading. That was the first the first period in March April when when the COVID broke down as outbreak came out as a pandemic situation. So that was the situation, and that fall in the that rise in the unemployment rate is mainly according to the CMI. They say that is due to the sharp fall in the labor force participation rate and the closures and the various restrictions, the social distancing measures, and all other measures. If we look into the salaried jobs, they have sustained a highest hit, and the salaried jobs were 86.1 million in 2019-20, and that fell to 67.2 million in July 2020. Now, if we look on to the left-hand side figure below the bottom figure, we see that there is a consumer pyramid survey which tells us that 52% of the job losses were among the population aged below 40 years. And that has serious implications on the consumer demand and the savings. Because if young people lose their jobs, the demand which is as it is being said that this kind of crisis can be tackled if the effective demand can be increased. And this, if these people lose their jobs, that has serious implications on the demand. So let us move on to the trade scenario. As we know that according to the WTO's Director General's statement, the unavoidable decline in the trade and the output have painful consequences on the households and the businesses on top of the human sufferings caused by the disease itself. And WTO has predicted a 30 to 32% decline in the global trade. And the trade slump is much more severe than the global financial crisis 2008-9. According to the outlook for trade 2020-21, three scenarios were being apprehended, but actually the first two scenarios, the relatively optimistic one and the pessimistic one, has gone, and we are left out with an assembling of the two scenarios where a sharp decline into 2020 can be merged with a equally dramatic change, rebound in the trade volumes that can bring closer to the optimistic scenario in 2021-22. And we know that prior to the corona, already the economy was going on a slowdown and there were trade tensions. We know the Sino-American trade war that was causing great problems to the world trade situation. And the corona pandemic actually deteriorated the situation. Now, what distinguishes this downturn from the earlier 2008 crisis is the role of the value chain and the trade in services. The trade is likely to fall more steeply in sectors that are characterized by complex value chain linkages in electronics and the automobile parts. So let us move to the Indian scenario. Now, if we talk about the Indian scenario, we'll find that this is the June situation in India. If we talk about India's merchandise and services trade exports, April to June 2020-21, it is estimated at US dollar 1.02 billion, which is exhibiting a negative growth of 25.92 in the same period last year. And in the case of imports, there is a negative growth of 45.10% as compared to the previous year. There were some commodities which I am not going to detail, which are recording positive export growth. So, which are some commodities which are showing negative export growth. And in the imports also there are negative export growth which are being recorded. If we look into the composition of the DGFT's latest figure, where India exports, USA is the trading partner where India exports 16.9% of its total merchandise trade. And if we look into the import composition, India, the maximum percentage that India exports is from China, 14%. Now, if we look into the services trade and the overall trade balance that has been put by the RBI, July 15, 2020, that says that in the trade balance, the services trade, India has a positive trade balance 6.83%. In merchandise trade, in June 2020, India had a positive balance of 0.79 billion as compared to the deficit of 15.2 billion in June 2019. First time in the decade, India is a net exporter. Already in the services, India has a 6.83 billion positive. So overall trade balance, April-June session is recording 11.70 billion US dollar billion positive balance, which is much better as compared to the deficit situation 26.32 billion in April-June the previous year 2019-20. Now, in this context, what has come up in recent times in the India's international relations or the foreign ties with China, which has been under scanner, may it be FDI, may it be economic ties after the Galwan attack and LAC, the Chinese full-warrior imperialist policy, the military aggression, the debt trap diplomacy has been under scanner and has been severely criticized. What China has tried to do, becoming the second largest GDP holder, is trying to apply those principles to become the largest superpower ahead of the USA, and the Sino-American trade war is one biggest example of that. The debt trap diplomacy, as we all know, where a creditor country like China deliberately lends excessive credit to a small debtor country with the intention of deriving economic and political benefits and concessions, trying to smother their economy, trying to control their economy, and when they become a defaulter. And that has happened to India's close neighboring countries like Sri Lanka, Myanmar, Pakistan, Nepal, and the foreign international relations are being under lots of criticism. If we look into the China's export to India and India's export to China, we will see that the trade deficit of India has increased over time. In the financial year 2019-20, India's import from China was $70 billion, and whereas export to China was only meager US 17 billion, resulting in a deficit of 53 billion. Now, in case of drugs, pharmaceutical products, electronics, electrical parts, and all other ingredients, final goods, these are the final goods that are being produced require ingredients or intermediate inputs, which are bought in large quantities from China. What we import from China is machinery, transport equipment, chemicals, office machines like automatic data processing machines, electrical machinery, appliances, telecommunication, sound recording apparatus, power generating machinery. In medicine, farmers, though the share has declined, but still close to 40% are still made by China. So my question is that yes, we did in the context of the recent scenario, the recent military aggression and the other policies, that imperialist policies which China has taken up in recent times, yes, we should boycott Chinese products, but without having a second alternative, without having an alternative source of intermediate inputs, can we totally boycott Chinese products altogether? Because India government has banned many apps, has banned many treaties, and stopped, cancelled many products. Those are being banned as a. It's good that should be stopped to make India Atmanirbhar or self-reliant. But should also think about alternative sources from where we can meet those intermediate inputs. So that brings my second, the second part of my trade, the interpretation of Atmanirbhar Bharat, as we, the students of economics, feel that the self-reliant, that matches with the Keynesian ideology. It means not borrowing money. That is, the value of exports must be matched by the value of imports. And side by side, developing domestic indigenous industries to curtail imports and reduce the dependence on foreign technologies. If we look into the UNCTAD's trade statistics in 2019, we see there are huge asymmetries in the pattern of trade between India and China. Manufacturing constitutes less than 50% of India's exports, whereas in case of China, it constitutes almost all of the merchandise trade. Now, trade deficit, balance of trade situation in India has actually balance of trade account has there is a deficit in the balance of trade, and it has increased from 1950s till date. But if we look into the China's scenario, China has maintained tried to maintain a positive balance of trade almost over the last 20 years or so. If we look into the goods that are being sold around us, the car manufacturing like Maruti, Hyundai, Honda, the computers where I am representing, computers like Dell, HP, Compaq, the Apples that we buy in Peter England, Van Heusen, Louis Phillips, these all these brands. If we look in all these brands, none of these brands are produced by China. So what has China done after liberalization in the 1970s? It has not tried to produce its own brand. Until recently, it is producing some Xiaomi, Vivo, Oppo mobiles or something like that. But it has become the manufacturer of all kinds of raw materials and supplying ancillaries to the world. And the world has become a manufacturing hub and an assembling hub. So it is trying to control the ingredient supply, the ancillary parts, and countries have to depend on China. So what can India do? Looking at its own comparative advantage, India can concentrate on its software exports by importing more of necessary hardware. Generic drugs by reducing import duty on ingredients. May concentrate on automobile industry by imposing tariff on the automobile import for allowing some kind of FDR. Now moving into the last part of the impact situation, what I told is in my presentation at the beginning, the structure of my presentation, that is the impact on the education sector. We start with the comment by made by the UNESCO's Director General. We are entering an uncharted territory and working with countries to find high-tech, low-tech, and no-tech solutions to assure the continuity of learning. We know that COVID-19 has imposed lockdown, social distancing, containment measures, and that led to closure of schools, higher education, colleges, universities, and that has posed tremendous uncertainty in front of us. And that will also pose the question between traditional versus online education. As we all know, that we are now on an online platform presenting webinars. Previously, we used to present webinars and students and teachers and other dignitaries were present in front of us. So cannot see each other. There are pros and cons of this online education. What are those? Briefly touching about the pros and cons. The traditional form of education where the student-teacher ratio is very high and the social distancing could not be guaranteed due to lack of infrastructure, particularly in the rural areas. And there are chances of community spreading, and wherever, in which country of the world they have tried to unlock, they have been forced to lock down again. The schools or colleges are again locked down. In e-learning, there is a need for reorientation of teachers, students, parents, and staff, as well as the major restructuring is required in the physical and the technological infrastructure in this sector. And the affordability of digital education, access to internet, mobile phone is a major issue, and the connectivity problems are also there. But what the pandemic has done has taken the incomes, because people are thrown out of their jobs. So how can we access the digital platform? So the government of India, Indian National Commission for Cooperation with UNESCO have come forward, and also the Ministry of Human Resource Development providing various platforms like e-Pathshala, Swayam Diksha, Swayam Prabha, National Digital Library, National Repository of Open Educational Resources. These are commonly platforms which are trying to provide some kind of support to online education to the students as well as the researchers in all fields of education. Now I will try to complete my presentation with three things which I have found in very recently, that as the unlocking has started, the recovery globally has also started, and India too is witnessing a V-shaped recovery in the manufacturing sector. Manufacturing Purchasing Managers Index (PMI) has recorded the first time 52.2, and it has moved to an expansionary zone first time since the lockdown. And this recovery was much essential, much more required for the Indian sector and to boost up the manufacturing sector. If we look at the FDI and FPI flows, there was a robust increase in FDI flows, though we say that FDI are less volatile and they are more concentrated, so countries want more of FDI and less of FDI. Though there has been certain decline, but still the growth has been robust in the pandemic era. And India has gathered or grabbed the highest portfolio in this during the first half of 2020 as compared to the emerging other market peers. And the optimistic this optimistic foreign investor sentiment is continuing in July and August, which is quite positive signs for improvement of the Indian economy. Now, if we move on to if we look at the foreign exchange reserve, that has increased from US dollar 59 billion in 2020-21 April to 537.5 billion in August 21, 2020, almost equivalent to 13 months import. And this has been due to the weakening of the global recovery, the dollar index, and the rise in foreign inflows in India, and the RBI actively intervening in the foreign exchange market to prevent the excessive rupees appreciation and the stopping or curbing the volatility of the foreign exchange market. Now, last but not the least, as time is a constraint, let me move on to my last slide, where I will present a few revival policies or strategies which India has already launched, and some countries of the some other countries have already launched. This is a proposal or suggestions. If I have tried to categorize it into three categories, it is my own classification. I have tried to consider it from my point of view. It is the demand management policies. As we know that this part of the crisis, economic crisis, has suddenly to move with effective demand. With the effective demand can be improved in the form of fiscal and monetary stimulus, with the government of India already announced 1.7 lakh crore package in 26 March, and then 20 lakh crore package, and for MSMEs 50,000 crores that can provide some boost up to the economy. At the same time, what Professor Ovi Vinayak Bandyopadhyay told us, cash transfer scheme and the unemployment insurance and also the PDS rational scheme has to be provided to the vulnerable sections of the society, those who are downtrodden people, so that they can earn their own ends meet. The extension of tax and debt payments benefit, EMI payments, and the reduction in interest rate that can boost up the investment incentive in the demand management sector. If we move on to the supply bottleneck strategies, we find there, if the country can develop its own supply chain linkages and reduce its dependence on foreign import, that is the strategy of self-reliance, what we have already called, then that can remove the supply bottlenecks. Then producing for the export market, both cheap and qualitatively better, the Make in India strategy and diversify products according to the comparative advantage can give the country some edge. The lowering of trade barriers, particularly on intermediate inputs, as I already talked about, the pharmaceutical products and other products, can encourage the economic-wide exports and earn foreign exchange. And regarding the specific sector-specific measures, the ILO has already suggested what we need is a workplace stimulation of the labor force demand, and also supporting the employment and the incomes according to the ILO suggestions. We should, in India, we must also concentrate on MT policy as a temporary boost up to the informal sector workers. We must also, in the educational front, we must also provide some kind of learning management system or something like that to provide access to the digital platform, so that the knowledge gap can be reduced. And also, if more and more investment can be brought about in the health and other infrastructure, and the R&D can be improved, then I feel the health pandemic can be combated. Also, we can formulate strategies of industrialization to make massive investment plans which can improve upon the demand management as well as remove the supply bottlenecks. These are very essentials, but not these are not the packages which says that these are the sole things which are responsible. There are many other things which are being discussed in many other forums, and our objective is to not only to combat the health pandemic, but to come out of the economic crisis that all countries are facing, the recessionary trends that all countries are facing, and we hope that these kind of measures can help us to come out of the crisis. Thank you. I think I must. The time is also over.
Thank you so much, sir, for your valuable speech. And now I would like to request Dr. Amarnath Das, Assistant Professor of Commerce and Head of the Department of Commerce, to chair the question answer session. Amarda.
Thank you, Subhasis. Thank you, sir. It's a very insightful deliberation. I collect some questions. The first one is, sir, in your
You are not properly audible.
Bit louder.
Amarnath, you are not properly audible.
hello, is
A
it
bit
okay?
loud.
Okay, sir. The first one is in your slide number 6. There was
Yes.
a data which shows the in respect of stringent restriction, and the value of the Russia, I mean, score of the Russia is 80.1, and India is
Yes.
85.6.
You are correct. You are correct.
Sir, but you see that the contraction, I mean, in
Is
GDP,
1.7.
in GDP contraction, it a point
minus 8.5.
more
Minus
than
8.5.
more than 23, or in case of in case of India more than 23%. In case of
Yes.
Russia, it's 8.5.
Yes,
So
you
why?
are correct, 100% correct. You
So
are
my question,
100% correct. Yes, tell me your question first.
it's interesting in nature perspective. It's almost same. I mean, just near 80 and 85. But in the context of GDP contraction, it's a huge gap. So my question
Yes.
is, could you cast some
Yes,
light over here?
before presenting, I knew that this question is going to come. So I was see there are some there are, if you look at countries, if you look at your data, there are some features which may not match always. See, these are things which are disturbing. This does not match the entire scenario where you see a high degree of correlation between the decline in the GDP and the stringency index. These are situations which are exceptional to the normal situation. You see, not only in that case, the decline in the GDP is minus 8.5, but you also see the fatality rate is lower than India. It is 1.7. So,
Yeah.
so interestingly,
Yeah.
India, as the government, this is not my statement. This is according to the government of India. They are saying that the more are the stringencies, the economy is going to contract more. According to them, and they have tried to establish the correlation between these two. This is not what I have worked out. This is something that has been worked out by the government and the Oxford, where they came out with this kind of correlation between these two indexes. But I think that there are something more other than there are some variables which we say maybe some other variables which should also be taken into account in considering the decline in the GDP growth. That if that is not taken into account, the sole factor of the stringency index does not account for a decline. This is my opinion.
Okay, okay. Sir, come to the next question. Please share your own view regarding imposition of stringent lockdown by Indian government during COVID-19. I mean, will you favor for it, or you think it's definitely not a good one for? Yes, yes. Please continue.
It will be a little bit controversial. I don't know whether to say correctly or not. I don't know. My logic is a country should unlock during the period where the curve is going down. But in case of India, what we have seen is, if we look into the unlock period, we have seen there is a rise in the daily rate of infection. Now, as per the government of India's explanation, they are saying that the more testing is done, and so more is the reflection in the COVID front. So that may not be always so, because during the first period, there was definitely the testing was much lower, and so the revelation of the COVID was much lower. But when the unlock started, we find that the infection rate also increased, but the stringency were there were, but people, what I feel is the government may impose lockdown, but it is up to the people, up to the society to take up the measures, so that whether they will follow the mask, whether they will maintain social distancing, maybe always policemen or policing or the impositions may not be applicable in practice. There are many situations where the lockdown were not properly being administered, and that I feel has resulted in an increase in the daily rate of infection during that period. Hello.
Hello. So
Yeah.
next one is we see in your slide that US maintain surplus balance of payment in the pandemic situation, but even if they suffered severely, how is it possible?
So a pandemic situation, balance of trade surplus does not depend on not only on the pandemic situation. It depends how they handle their trade situations. In case of India, you must have heard about this situation where people are saying that there are some parent firms which are trying to lock down from China and trying to re-establish in India, and some incentives were also given so that they can come to India. But if I say incentives are given and if I do not apply in practice, there is an index called the foreign index of location index, AT Carnes index, which says the attractiveness of FDI and the FPI and the improvement in the trade not only depends on how I manage the lockdown, but also the measures on the trade situation that I take. Already, the global situation in trade was going down because of the Sino-American trade war. There were duties imposed on China and US products. But China and US have tried to maintain a balance of trade surplus, which India has never done. India, what they have done is they have in recent times, as I have shown, that in June, quite astonishingly, they have got a balance of trade, an overall surplus in both services and merchandise trade of 11.70 billion, which is quite astonishing as compared to it has never happened in the decade. That has been due to a decline in the imports and slight improvement in the exports. So I think that the trade policies govern the situation of maintaining trade balance and not how they maintain the pandemic. That may be one of the factors, but controlling the trade situation is much more important in maintaining trade balance, positive trade balance as compared to others.
Last one.
Yes.
In your conclusion, you advocate reduction of import duty on generic ingredients or products. So it also contribute deficit balance of payment. So how to tackle, I mean, how to balance this?
I know this kind of, there are people who are saying that in recent times the deficit will soar up as if India gives more loan or India gives concessions. But you see, this is a special, pandemic is a special situation. We have to first think of how to come out of this situation, then tackle the deficit situation. What I feel, according to priority, if you prioritize, if we don't allow concessions on intermediate products, what will happen is our export sector will have a reduction. And this export boom cannot be continued over time, which we had experienced in recent times. And that can have serious implications on the balance of trade scenario, which we have suddenly got a positive situation in the balance of trade. So what I feel is if we prioritize, maybe we will have some kind of balance of deficit part, there will be certain increase. But if we don't allow, we cannot boost up our exports. And if we cannot boost up our exports in the trade front, we are going to lose a great thing. And this is a situation where some companies are trying to relocate from China, close down from China, and trying to re-establish in India. So we should take advantage of this situation and should allow them so that they can reallocate them and we can take advantage of making India strategy.
Last one offbeat question, if you allow. The question is, sir, in this situation when the GDP growth is negative, more than 23%, how stock market is going up? I mean, we have seen the ups and down up to 7,500 to now it crossed 11,000. So how is it possible?
I think you yourself has done a lot of work on the stock market. You know very quite clearly that stock market index that does not depend on one thing, one macroeconomic variable. That depends on various factors, multi-dimensional factors. It depends on the stability, depends on the trade situation, depends on the governance, the many situations, the prospects of boom and the future, the business cycles and so on and so on. So it depends on also the banking and the other financial situations. So definitely there are some measures which have been taken up in recent times to boost up the stock market, and government of India, also the RBI is, the SEBI is taking some measures. So there are no stock market bubbles in this situation. They are taking into the situation this kind of restrictions, this kind of governance, so that this kind of bubbles do not occur. And these situations, I think, has controlled in some respect and responsible for the boom, though the GDP is showing a decline.
Is it not natural?
No,
I mean, what
I
we,
wouldn't say natural. It's something that depends on other factors. I feel that there are some other factors other than GDP, which is now boosting the stock market scenario, other than the GDP. Because you see, comparatively, all countries of the world are experiencing a GDP decline. So, where to invest? Not only the Indian GDP is declining, all the countries. So people must find avenues where to invest. So comparatively, Indian market is much more secure as people are feeling, and that's why foreign portfolio investments are coming. So that may be the security of the investment. That may be one prime factor, and the governance of the RBI, that may be one of the factors that is boosting this scenario, because alternative investment scenario are being locked in many countries.
yeah, many thanks, many thanks. It's
Thank
much
you.
more insightful. Thank you, sir. I try to hand over Subhasis. I'm audible, Subhasis.
Yes, thank
Thank
you.
you, thank you, thank you, sir.
Thank you so much, sir, for this interactive session, and thank you, Amananda, for chairing the session. Once again, we express our heartfelt gratitude to Dr. Kuntal Das, Senior Lecturer in Finance, and Dr. Rajiv Bhattacharya, Associate Professor, Department of Economics. I think surely this will help our students with much insights and intelligence, and will further lay out a research domain in near future. Okay, so we are heading towards the end of our session, and to officially announce the wrap up of today's session, or today's one-day international webinar, I am handing the microphone over to Dr. Probit Dotto, Associate Professor of Commerce, to convey vote of thanks. Sir.
Hello.
Yes, sir. Audible.
Hello.
Audible, sir. Please go on.
Hello. Hello, respected teachers, dignitaries, and my beloved students. Now it is the time to. Am I visible?
Yes, sir, you are visible and
Yes.
audible.
Now it is the time to end today's international webinar titled Contributing Components to Bank Crisis and Macroeconomic Impact of COVID, organized by the Department of Commerce, Navagram Hilalal Pal College. Actually, this webinar is a rescheduled webinar because we fixed the date of this seminar on 1st September 2020, but due to demise of our ex-president Pranab Mukherjee, we have to postpone the webinar. Today we are holding the webinar. Now it is the time to give a vote of thanks on my behalf. Keeping in mind that today's market is a consumer's market, that is, consumer are the supreme. So in my mind, today's audience is the consumer. So at first, on behalf of the Department of Commerce and Navagram Hilalal Pal College, I extend my heartfelt thanks to the audience who have listened to the lectures of two respected speakers with lots of patience and eagerness. The questions they have put before the speakers are praiseworthy. Many thanks, and hope they will with us in future too. Again, thanks to our audience. Thank you all. Next, it is our turn to offer vote of thanks to our two respected speakers. To my mind, they are the producers of the lectures. Our first speaker, Dr. Kuntal Das, from the University of Canterbury, New Zealand, delivered lecture on the topic bonanzas, booms, and banking crisis. He pointed out the ori of Indian economy is NPA, net performing asset in banking sector, which is growing and relatively more compared to other countries. Return on asset on banking sector of India is negative. Return on equity of banking sector of India is declining. Bank net interest margin in India is sinking. As a result, what happened? Bank is the major source of credit supply. If NPA increases, credit supply of bank will be sinking. As a result, GDP will be declined. There will be currency crisis, debt crisis, foreign capital crisis. How to stop bank crisis? There are two theories, according to Dr. Kuntal Das. One theory is competitive theory, and second theory is concentration theory. That is large few banks. Actually, he made a research on the bank crisis, and two parameters, that is competitive theory and concentration theory, has been taken into consideration. His findings is that concentration theory hold goods to stop bank crisis. Apart from that, he also pointed out that gross and net international capital inflows, that is called bonanzas, along with foreign technologies and expertise to the financial system of countries having low domestic savings, may increase the productivity, standard of living, and economic growth. But such bonanzas at the same time increase probability of bank crisis, dislocation in the financial system, fuel asset price bubbles, and thus it increases risk. His findings is also that among three components of international capital inflows, namely foreign direct investment, portfolio equity, and debt, his finding is debt is more risky inflow components for both gross and net inflow bonanzas. Our heartfelt gratitude to Dr. Kuntal Das. Thank you, sir. Thank you, sir, on behalf of the department and Navagram Hiralal Pal College for giving your precious time to us. Thank you. Many, many thanks to you. Our next speaker, Dr. Rajiv Bandyopadhyay from Goenka College of Commerce and Business Administration. He delivered lecture on the topic macroeconomic impact of corona pandemic with special focus on Indian economy. He cited some areas where COVID-19 has an impact, macroeconomic areas where COVID-19 has given some impacts. One severe decline in the growth of economy, GDP decline. India is the highest decline growth in GDP, growth rate 23.9% in comparison to all other countries of the world. Lockdown makes death rate low in compared to other countries of the world. Government response strategy index in case of India is highest, 85.6. Sectoral impact of COVID-19, highest adverse impact on manufacturing sector, wholesale, retail, real estate, business, transport, mining, quarries, etc. Job market, health shock has turned into an economic and labor market shock. The employment impacts on impacts of COVID-19 is deep. 93% of the world's workers are affected. Huge unemployment among educated people in India. Salary drops. Serious implication on the demand side of the economy. Global trade decline. Import-export decline. But there is a positive trade balance in case of India. Online education system. He also suggests some strategies and policies of revival of Indian economy. Our thanks to Professor Rajiv Bhattacharya for his enlightening comments as well as his speech delighted us. Thank you, sir. Thank you very much. Next, we come to our management. The crucial link in bringing together the speaker and audience on a single platform. All my gratitude to the following persons. The president of the governing body of the college, Sri Apurva Mojumdar, for his inaugural speech. Thank you, sir. Principal, Dr. Srikanto Samanto, for welcome address. Thank you, Dr. Srikanto Samanto. The convener, Shakho Sina De, Sambhavat, right? For his Shakho Singho De, for his skillful organization. Thank you, our convener. Thank you, Shakho Singho De. HOD of the Commerce Department, Dr. Amarnath Das, for his active support. Thank you, Mr. Das. Professor Subhashish Borua for acting as host. Thank you, Mr. Borua. Other members of the organizing committee, Professor Subhendu Kundu, Professor Kaushik Dari, and Professor Suparna Rai. Thank you all for your help and support. Not but last of all, Mr. Dept Das. Last but not least, he has given us technical support. Thank you, Mr. Das. Apart from all other members who have contributed to the webinar directly or indirectly, thank you all. Thank you all, everybody. Thank you. Thank you, everybody. Good night. Okay.
Thank you all for participating. So here ends our one-day international webinar organized by Department of Commerce, Navagram Hiralal Pal College. Thank you all.